Most corporations have one specific motive: to make profits. But Vanguard isn't like most. In fact, they're quite the opposite. If you think about the most well-known publicly traded companies, such as Amazon, Apple, or Tesla, they all have shareholder expectations to meet, and that requires them to raise prices, lower costs, and in turn make a profit. But on the other hand, Vanguard has been dropping prices for years now, and it'd be very difficult for you to find a non-Vanguard ETF or index mutual fund with lower prices than Vanguard's comparable funds. You may be thinking, Ben, you're just biased because you invest with them. I don't believe you. Let's take a look at the data. The Vanguard's fund average expense ratio is 0.19% versus the industry average of 1.08%. That's a 5x multiple. And you gotta keep in mind that these funds are controlling hundreds of billions of dollars of assets under management. I mean, that statistic alone should make you wonder why the hell you're not even investing with Vanguard. But if that still doesn't seem to convince you, there's two things that Vanguard has that sets them apart from its competition and other investment firms. Vanguard provides its services to Vanguard funds at cost. That means that their funds cost the investors the same amount of money it costs for them to run. And second, Vanguard is client owned. As a client owner, Vanguard owners own the funds that own Vanguard. The only shareholders Vanguard has are its own customers. They are not a publicly traded institution driven by financially incentivized shareholder greed. This kind of structural accountability and transparency is what really allows Vanguard to outshine its competitors and be the world-leading investment firm. Again, as the biggest financial services company in the whole world, their set it and forget it target retirement funds are some of the most popular funds out there and have a ridiculous amount of money and assets under management. They're managing over hundreds of billions of dollars in their retirement funds and have over $7.2 trillion of assets under management. That's a lot of money, people, and reputation on the line. And Vanguard's reputation is its biggest asset of them all, which is why they've grown so exponentially as a company over the past few years. Now, this isn't a video saying that all the other investment brokerages out there are terrible. I have an account with multiple other brokerages, as some offer lower cost stocks, bonds, non-Vanguard fund trading, and differentiating services. However, if you want the lowest cost to passively investing your money into an ETF or index fund, Vanguard is definitely the top dog. According to Vanguard's research, more and more of the younger generation, primarily millennials, are opening Vanguard IRA accounts way faster than the older generations, primarily millennials born after 1985. It's a telling sign that when you have structurally better incentives with lower costs and commission-free ETFs, people start talking and the word spreads around. And millennials are understanding now that passively investing their money at a young age is crucial. More importantly, for those who have a Vanguard IRA, millennials are torching the boomers and Gen Xers and actually contributing to one. Looking at the graph, it's more than double the participation rate of older cohorts. And interestingly, when comparing all three of the generations, millennials are on track for the biggest projected balances in the retirement funds. Maybe I went off on a little tangent there, but I thought this information was interesting. So as a leader in commission-free ETF trading and their customer-owned structure, it's no question that you should be seeking out passively managed ETFs and index funds at very low cost. Even Warren Buffett, the richest investor of all time, is a big fan of index investing. In a Berkshire Hathaway shareholder letter, he had this to say where he would suggest the trustee of his estate to put his money when he died. 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. I suggest Vanguard. So from a non-Nigerian or a 90-year-old guy who's been in the game for decades now, even Buffett recommends investing in the S&P 500 index funds with Vanguard. But when you take a look, Vanguard has 3 S&P 500 index funds, and all 3 of them invest in all of the same 500 companies. So what's the difference between them, and which one should you choose? First, let's look at an overview of each of the Vanguard S&P 500 index funds. Starting with VOO, Vanguard's S&P 500 ETF. The type of investment is an index ETF. Their expense ratio is 0.03%, and they have no minimum investment required. The performance of VOO over the last year has been 12.94% annualized. Their performance over the last 3 years has returned 13.68%, and their performance over the last 5 years, 12.15%, and their performance over the last decade has been 12.61% annualized. Next, we'll take a look at VFINX, a Vanguard S&P 500 index fund for the investor share class. This type of investment is an index mutual fund with an expense ratio of 0.14%. This index fund is actually now closed to new investors, so you can't put a minimum investment down, but its performance over the last 1 year has been 19.42%, over the last 3 years 14.44%, performance over the last 5 years 12.15%, and performance over the last 10 years has been 12.71% annualized. So only a 0.10% change in the performance over the last decade between VOO and VFINX. Lastly, the third Vanguard S&P 500 index fund, symbol VFIAX, is also an index mutual fund with an expense ratio of 0.04%, has a minimum investment of $3,000, and its performance over the last 1 year was 12.96%, performance over the last 3 years 13.67%, performance over the last 5 years 12.16%, and performance over the last 10 years has given 12.62%. And so when you're looking at the returns for each of the funds, there's actually not a significant difference between them. Now let's take a look at the type of funds. The first difference you'll notice is that VOO is actually an ETF, while VFIAX and VFINX are both index mutual funds. ETFs are short for exchange traded funds, and mutual funds differ in how they're traded and evaluated. ETF shares are traded and evaluated on the stock market throughout the trading day. Mutual fund trades are executed after the market has closed for the day. Mutual fund share prices are determined by the NAV, or the net asset value, of all of its holdings. And ETF market prices are influenced by the NAV of the holding, but are primarily based on the actual trades that have been taken on the market and not the value of the holding. Most investment brokers will charge you a fee on the initial purchase or sale of a mutual fund. For ETFs, you're potentially charged every time you buy or sell shares. This is also a key distinction that separates Vanguard from all the other investment firms. You can buy or sell Vanguard ETFs and index funds with no purchase or selling fees. With VOO, there's no minimum investment amount. VFINX has closed to new investors, and Vanguard had dropped the investment amount for VFIAX to $3,000 to make it more accessible to beginner investors. The next notable difference is the expense ratios. This is the cost for what you actually pay for the management of these funds. VFINX has an expense ratio of 0.14%, which is actually very low compared to the standard, while VFIAX is less than a third of that expense ratio at 0.04%. The reason why they're lower is because their shares are considered admirable shares, or the preferred shares. And as for the ETF VOO, it actually has a slight edge on the expense ratio, coming in at 0.03%. Not too much of a difference, but they do win in that department. Again, you'll notice that there's virtually no difference in all of the performance returns between all three of the index funds. They all nearly have identical performances, and if you had put them all on a chart, you see that they all overlap over time. Looking at the average annual performance between Vanguard S&P 500 ETF VOO and the index fund, you'll see that its year to date is 16.87%, and all of its 1 year, 3 year, 5 year, and 10-year returns are all virtually identical. And when looking at the average annual total returns after taxes on distributions, they're virtually all the same with no differences in the returns. So in other words, the investment performance between each of these funds shouldn't really impact your decision on which one to choose. Although the investment funds and returns are all identical, it actually makes a difference on which one you choose. If you haven't already invested in VFINX, you can't, as it's closed to new investors. But even if it was, VOO and VFIAX are better alternatives because of their lower expense ratios. And so when you take a look at VOO versus VFIAX, if you're investing with a non-Vanguard investment firm that doesn't have free ETF trading for VOO, then VFIAX is probably the better alternative for you over the long run. But if you do invest with Vanguard's brokerage, then VOO and VFIAX are virtually the same in terms of their investment returns, but not the same with the minimum investment down required for VFIAX. And so there you have it, with a review of Vanguard and each of the S&P 500 funds. The bottom line is that Vanguard is a company that's structurally different from all the other brokerages, and it gives retail and amateur investors like you and me the best chance to realize investing success, which is why I personally invest with Vanguard. Let me know which S&P 500 index fund you invest with and why. I'll catch you guys later. Take care.